How's it going, everyone? My name is Jeff. Just kidding. My name's Imran. I'm an engineer who likes finance, but I'm also lazy. And if you're lazy like me, investing in individual stocks is not the greatest strategy. In this video, I'll show you a safer and lazier investment than stocks. There's a few issues with buying individual stocks. It's really easy to pick one or two stocks and go all in, which is exactly what I did when I first started investing. I went all in on Microsoft because I thought, well, the whole world runs on Microsoft, so what could go wrong? While it's been a great investment so far, I could have easily chosen a company that hasn't done well, like GoPro. GoPro? More like go broke. Okay. Oh, I get it, because GoPro was down -5% in the last 5 years, so you would go broke. Oh my god, you are so funny. Okay, well, you might be saying diversify. Buy shares of several different companies. That way, if one of them tanks, you'll still be good. How do you know what companies to pick? What if you're not an experienced investor, you know, like the majority of the world? Most people don't even know what a stock is. Yeah. Hey, shut up, black and white version of me. You're making me feel gray. Okay, I see what you did there. No. Why you gotta suck the color out of everything? Man, you are on a roll. I think I don't like you. Someone's feeling a little vibrant today, huh? I don't hate you after all. Look at that face. That's a good face. Anyways, it takes time to analyze and research good companies to invest in. The issues I just mentioned could potentially lose you money and are time consuming. So what are the alternatives if you're lazy like I am? What if you can buy shares of a single company, let's call it, and this company will do all sorts of complex research and analysis for you, then invest your money into companies they think are the best. To top it off, what if they continue to analyze these companies and move your money around over time to get you the best bang for your buck? You can set it, forget it, which is perfect for us lazy people. Spoiler alert, exchange-traded funds, or ETFs, are exactly this. Instead of buying shares of a company like Microsoft, you buy shares of an ETF. It looks and feels exactly the same as purchasing stocks, but with the benefits of having experts taking care of the research and transactions for you. Cool, now you know what ETFs are. Let's quickly take a look at some popular ETFs just to get you an idea of what's out there and how much money you can make. First up is the SPDR S&P 500 or SPY fund. Don't freak out about the name, it's gonna be okay. SPY is a fund that tracks the S&P 500, which is just a fancy way of saying 500 publicly traded companies like Microsoft. SPY is almost 30 years old and has an average annual return of about 10%. The last 5 years, the return has been 102%. That means if you invested 5 years ago, you would have doubled your money by now. SPY is one of the most popular ETFs out there, and it's popular because it's safe. And it's safe because it's well diversified, it's been around for 30 years, and it has a pretty solid return. Let's do some quick math to see how much money we can make in the long term with the SPY ETF. If you invest $10,000 into SPY today and continue to invest $500 every month for the next 30 years, you'll have about $1.25 million before inflation. That's assuming an annual return of about 10%, which is not always the case. Another popular ETF is called ARK Innovation, or ARKK. ARK is less than 7 years old and has an annual average return of about 34%. In the last 5 years, it's had a return of over 400%. 400%. That means if you invested 5 years ago, you would have quadrupled your money. ARK is considered way more risky than SPY because there are only about 50 companies in the fund compared to 500 in SPY. Most of the fund's money goes into 20 of those 50 companies, making it even more risky. So what you're saying is ETFs are the perfect investment. Got it, I'm out. ETFs are not perfect. There are some disadvantages to them. Let's quickly talk about that. Hey, I can snap better than you, but before I do that, you're probably super pumped on ETFs right now and want to start buying them. If you sign up with Webull using my referral link in the description below, you'll receive up to 2 free stocks worth up to $2,000. While you're on a roll, get yourself some free Bitcoin by signing up with BlockFi using my referral link. You'll even earn up to 8.5% interest on certain cryptocurrencies. Click that like button and subscribe if you haven't already. If you're into social media, you can follow me on Instagram, where you can see how weird I really am. One of the disadvantages of ETFs is poor management. If you happen to choose a fund that's poorly managed, you could lose money. This is where a little bit of research goes a long way. I would avoid new ETFs and ones that sound too good to be true. The biggest drawback to most ETFs, in my opinion, is that there are fees for having companies manage the fund for you. The most common type of fee is called an expense ratio. Don't freak out, it's just a name. An expense ratio is just a small percentage taken out of your investment throughout the year. Let's say you invest $1,000 into an ETF that has an expense ratio of 1%. To keep it simple, let's also say your $1,000 investment stays the same throughout the year. It doesn't go up, it doesn't go down. The fund managers will take $10 as a part of the expense ratio fee. 1% doesn't seem like a lot, but over time it becomes significant, which is why 1% is pretty expensive. The SPY and ARKK ETFs have an expense ratio of 0.095 and 0.75% respectively, which is a huge difference. Speaking of small percentages, did you know that most savings accounts only offer 0.1% interest? Watch this video to learn more about why a savings account could be costing you money. And thanks for watching. Okay, thanks for watching. Okay.